Hello and welcome back to the channel. Today we're diving deep into a fascinating topic that's got a lot of investors talking: the gold to silver ratio. What is it? Why has it been falling recently? And most importantly, what could this mean for the future of precious metals? If you're invested in gold or silver, or even just curious about market dynamics, you're going to want to stick around for this. So let's start with the basics. What exactly is the gold to silver ratio? It's actually a very simple concept. It tells you how many ounces of silver it takes to buy 1 ounce of gold. For example, if gold is trading at $2,000 an ounce and silver is trading at $25 an ounce, the gold to silver ratio would be 80. You just divide the price of gold by the price of silver. 2,000 divided by 25 equals 80. This ratio has been tracked for centuries, and it gives us a historical perspective on the relative value of these two precious metals. Historically, this ratio has fluctuated wildly. We've seen it as low as 15 to 1 and as high as over 120 to 1, which happened during the market panic in early 2020. A high ratio generally means that gold is expensive compared to silver, or that silver is cheap relative to gold. Conversely, a low ratio suggests that silver is becoming more expensive relative to gold. For a long time, the average in the 20th century hovered around 50 to 1. So when the ratio moves significantly above or below that average, traders and investors start paying very close attention. They use it as a signal, a potential indicator of which metal might be undervalued or overvalued at any given time. Now for the main event. Why has this ratio been falling recently? Over the past several months, we've seen a pretty significant drop from the higher levels we saw previously. This means silver's price has been outperforming gold's price. There isn't just one single reason for this. It's a combination of several powerful economic factors all working together. Let's break them down one by one. The first major driver is the outlook for global economic growth and the industrial cycle. This is where gold and silver really show their different personalities. While both are considered precious metals and safe haven assets, their uses are quite different. About 80% of gold's demand comes from jewelry and investment, like bars and coins. It's primarily a monetary metal. Silver, on the other hand, is a hybrid. It's part precious metal, part industrial metal. Over half of all silver demand comes from industrial applications. We're talking about electronics, solar panels, electric vehicles, medical equipment, and so much more. Silver has the highest electrical and thermal conductivity of any metal, making it indispensable in modern technology. So, when the global economy looks like it's picking up steam, when manufacturing activity is increasing, and when there's a positive outlook for industrial production, the demand for silver gets a huge boost. Think about the green energy transition. The push for more solar panels and electric vehicles is incredibly silver intensive. A single solar panel needs a good amount of silver, and an electric vehicle uses significantly more silver than a traditional internal combustion engine car. As governments and corporations worldwide invest trillions into this green transition, the structural demand for industrial silver is set to grow for years to come. This improved growth outlook makes silver more attractive to investors who are betting on an economic recovery or expansion. Gold might do well during times of uncertainty and fear, but silver tends to shine when things are looking up for industry and manufacturing. So a key reason the gold to silver ratio has been falling is simply that the market is pricing in stronger economic growth, which benefits silver's price more than gold's. The second major factor we need to talk about is the US dollar. There's a well-known inverse relationship between the US dollar and commodity prices, especially precious metals. Typically, when the dollar weakens, the price of gold and silver, which are priced in dollars, tends to rise. This is because a weaker dollar makes them cheaper for investors holding other currencies, which can boost demand. Recently, we've seen a softer trend in the US dollar. This can be due to many things, like the Federal Reserve's monetary policy. If the market anticipates that the Fed will stop raising interest rates or even start cutting them, the dollar tends to weaken. A lower interest rate environment makes holding non-yielding assets like gold and silver more attractive compared to holding cash or bonds that pay interest. When the dollar softens, both gold and silver usually rally. However, silver often reacts more strongly. Because the silver market is much smaller and less liquid than the gold market, the same amount of investment capital can have a much bigger impact on its price. So, a weakening dollar can cause silver to outperform gold, which in turn pushes the gold to silver ratio lower. Investors who are bearish on the dollar often look to silver as a leverage play on that weakness, expecting it to deliver bigger percentage gains than gold. This brings us to our third point: silver's unique market positioning and its inherent volatility. Let's be clear, The silver market is the Wild West compared to the gold market. The total market for silver is a fraction of the size of the gold market. This means that its price can be much more volatile. It's famous for its dramatic price swings both up and down. Because of this volatility, silver attracts a different type of speculator. When sentiment turns bullish for precious metals, a flood of money can pour into the relatively small silver market very quickly. This can create explosive price moves to the upside. We often see this happen when the gold price starts a sustained rally. Initially, gold leads the way. But once the trend is established, investors looking for higher returns often rotate out of gold and into silver, hoping to catch a bigger wave. They see silver as poor man's gold, or a high beta version of gold. This rotation accelerates silver's price gains relative to gold, causing the ratio to fall, sometimes very sharply. This process is often called a catch-up trade. If gold has been steadily climbing and the gold to silver ratio is historically high, traders will bet that it's only a matter of time before silver closes the gap. This becomes a self-fulfilling prophecy. The expectation of silver outperforming gold leads to buying, which causes silver to outperform, which lowers the ratio and attracts even more buyers. It's a classic momentum trade. So what comes next? Where does the ratio go from here? Looking ahead, the direction of the gold to silver ratio will likely depend on those same three factors we just discussed: the health of the global economy, the direction of the US dollar, and overall investor sentiment towards precious metals. If we see continued strength in global manufacturing and a sustained push towards green energy, the industrial demand for silver should remain robust. This would be a powerful tailwind for silver's price and would likely keep pushing the ratio lower. If major economies avoid a deep recession and continue on a path of moderate growth, silver is positioned to do very well. On the monetary policy front, if the Federal Reserve and other central banks begin an easing cycle and start cutting interest rates, this would likely lead to a weaker dollar. As we discussed, a weaker dollar is typically bullish for both metals, but especially for the more volatile silver. In this scenario, we could see the ratio continue its downtrend as capital flows into precious metals as a hedge against currency debasement. However, it's important to consider the other side of the coin. If the global economy were to unexpectedly slow down and fall into a serious recession, industrial demand for silver could plummet. In such a scenario of economic fear and uncertainty, investors would likely flock to gold as the ultimate safe haven, causing gold to outperform silver and the ratio to spike higher. Similarly, if inflation proves stickier than expected and central banks are forced to keep interest rates high for longer, this could strengthen the dollar and create headwinds for both metals. So for investors, the gold to silver ratio can be a useful tool, but it's not a crystal ball. It's one piece of a much larger puzzle. Many traders use the ratio to time their entries and exits. For example, when the ratio is very high, say above 90, they might consider selling some gold to buy silver. When the ratio is very low, say below 60, they might do the opposite. It's a strategy of rebalancing between the two metals based on their relative value. In conclusion, the recent fall in the gold to silver ratio is a multifaceted story driven by expectations of better economic growth, a softer US dollar, and silver's classic tendency to play catch-up to gold in a bull market. It signals a shift in market sentiment, away from pure safety and towards assets that also benefit from industrial expansion. What do you think? Do you believe the ratio will continue to fall, or are we due for a reversal? Let me know your thoughts in the comments below. It's always great to hear different perspectives from our community. Thank you so much for watching. If you found this video helpful and want to learn more about the fascinating world of finance and investing, make sure to hit that like button and subscribe to the channel so you don't miss our future content. We'll see you in the next video.